Every insurance company you've ever done business with has a word for you, not your name. A classification, buried inside their internal systems, that has nothing to do with how many claims you've filed and everything to do with one specific question: how likely are you to ever leave? If you've never shopped around, never called to negotiate, never once threatened to switch providers, there's a good chance the word attached to your file is some version of sticky. And sticky customers, in the internal language of the insurance industry, are the most profitable customers there are. This isn't a video about whether insurance companies are good or bad. It's a video about a pricing mechanism most policyholders have never heard of, one that has almost nothing to do with your actual risk of filing a claim, and almost everything to do with your risk of leaving. By the end of this video, you'll understand exactly how that mechanism works, what it's costing you specifically, and what changes the moment you stop being the kind of customer it's built to extract the most from. Let's start with the metaphor I want you to hold on to for the rest of this video, because we're coming back to it more than once. Picture a subscription you forgot you had. Not a scam, nothing illegal, just a service you signed up for years ago that auto-renews quietly every month, and you've simply stopped checking the price. The company isn't doing anything to you that a court would call fraud. They're just relying on the fact that inertia is more profitable than honesty, and that most people would rather keep paying a slightly bad price than spend 20 minutes finding a slightly better one. Insurance pricing, for a huge share of policyholders, runs on exactly that same principle, just at a much larger scale and with far more money involved. Here's the industry term, and I want you to actually hear it, because once you know it exists, you'll never look at a renewal notice the same way. Insurers internally refer to a subset of their customer base as price-inelastic policyholders, or in blunter internal shorthand used at several major carriers, simply as the base. The base isn't defined by how safely they drive, how healthy they are, or how well-maintained their home is. The base is defined by one measurable behavior: they renew every year without comparing prices anywhere else. And here's the part that should genuinely bother you. Actuarial pricing models at major insurers don't just track this behavior, they price against it directly, on purpose, year after year. This practice has an actual academic name, and it comes up repeatedly in state insurance regulatory filings and industry pricing literature. It's called price optimization, and for years it operated almost entirely outside public awareness. Because the mechanics of it are buried inside actuarial software that customers never see and regulators only recently started scrutinizing closely. Here's what price optimization actually does, stripped of the euphemism. It takes your risk profile, the genuine actuarial data about how likely you are to file a claim, and then it layers a second, completely separate calculation on top of it. One that has nothing to do with risk at all. That second calculation estimates your personal elasticity, meaning how sensitive you specifically are to a price increase, based on your renewal history, your demographic profile, and, in some documented cases, even how you first found the company, whether through a price comparison site, which signals sensitivity, or through a direct mail renewal, which signals the opposite. If the model predicts you're unlikely to shop around, your renewal price increases by more than a customer with an identical risk profile who has shopped around in the past. Two people, same age, same driving record, same coverage, same car, same house, same everything that actually determines risk, can receive meaningfully different renewal quotes, purely because one of them has a documented history of comparing prices and the other doesn't. This isn't a hypothetical. Several state insurance regulators, including in California, Ohio, and Maryland, have investigated and in some cases restricted this exact practice after consumer advocacy groups flagged it using data obtained through regulatory filings. The practice was significant enough and clear enough that multiple states passed specific rules requiring price optimization based on non-risk factors to be disclosed or curtailed. That's not speculation. That's a matter of public regulatory record. Let's make this concrete with a specific case that mirrors what shows up repeatedly in consumer complaint data and industry analysis. Consider a woman I'll call Alina. Alina had auto insurance with the same company for 9 years. Same car, replaced once for a nearly identical model, clean driving record the entire time, zero claims. Over those 9 years, her premium rose from around $1,100 annually to just over $1,900 annually, an increase of roughly 73%. During a period when her actual risk profile, by every measure the company itself uses to price risk, had not meaningfully changed. Alina assumed this was just how insurance worked, that prices simply rise over time the way everything does. In her 10th year, almost by accident, Alina's sister convinced her to get a comparison quote from a different provider before her renewal date, purely because the sister's own premium had dropped after switching. The quote came back at just under $1,200 annually for identical coverage from a company with comparable financial strength ratings. Alina wasn't a worse driver than she'd been 9 years earlier. She wasn't a more expensive risk by any measurable standard. She was, for 9 consecutive years, simply the base. A policyholder who renewed automatically, never called to negotiate, never requested a comparison, and whose price crept upward specifically because the pricing model had learned, correctly, that she wouldn't push back. Here's where the subscription metaphor becomes precise, rather than just illustrative. When Alina called her original insurer to cancel, explaining she'd found a lower rate elsewhere, the retention department, a team that exists at nearly every major insurer specifically to intercept cancellation calls, offered her a new rate within about 4 minutes. $1,250 annually, almost exactly matching the competitor's quote, not a rate that had been unavailable to her for the past 9 years. A rate that existed the entire time, sitting in the same pricing system, available specifically to customers who called and said the word cancel. This is the mechanism worth sitting with directly. The retention department's 4-minute counteroffer proves, by itself, that the higher price was never actually justified by risk. If a $1,250 rate was profitable enough to offer the moment Alina threatened to leave, it was also profitable enough to have offered her the year before. And the year before that, and the 7 years before that. The only variable that changed between her paying $1,900 and being offered $1,250 was that she finally behaved like a customer who might actually leave. The subscription analogy holds exactly. Nobody adjusts the price of the forgotten subscription until you actually go looking for the cancel button. Now, let's talk about why this works, mechanically, because it's not simply that insurance companies are unusually predatory compared to other industries. It's that insurance sits inside a category of products economists call low salience recurring expenses, meaning the cost is real and substantial, but it's paid infrequently enough. Once a year for most policies, and it's complicated enough to compare that most people simply never build the habit of checking it. Compare this to something like a streaming subscription, where the entire product exists on a screen you look at daily, making a price increase impossible to miss. An annual insurance premium arrives as a single line on a renewal notice you might not even open carefully. Buried among fine print about deductibles and coverage limits that most people have never fully parsed in the first place. The infrequency and the complexity aren't incidental. They're the entire mechanism that makes price optimization viable at scale. There's a second layer to this worth naming, because it compounds the first one significantly. Insurers also track something called your quote-to-bind ratio and your historical shopping behavior across the broader market, often through data-sharing arrangements with comparison sites and credit-based insurance scoring systems. If you've never generated an outside quote in the years the insurer has data on you, that absence itself becomes a data point feeding directly into your renewal pricing. You are, in a very literal sense, penalized for a behavior you never performed. which is the digital equivalent of a store raising your prices, specifically because you've never once asked whether a sale was happening. I want to be precise about something here because it matters for how you act on this information. This isn't a claim that every renewal increase is price optimization in action. Insurers do face genuine rising costs, more expensive vehicle repairs due to complex sensor technology, increased litigation costs, climate-related claim frequency in certain regions, and legitimate risk pools that shift over time. Some of your renewal increase, quite possibly a meaningful portion of it, reflects real cost pressure across the entire industry. But the documented existence of price optimization means you cannot assume your specific increase is entirely explained by that legitimate pressure. And the only way to find out which portion is real risk-based pricing and which portion is elasticity-based pricing is to actually generate an outside comparison and see what number comes back. So here's what actually breaks the mechanism, and it's simpler than most financial advice tends to be, though it requires overcoming exactly the inertia the pricing model is betting on. First, get an outside quote before every single renewal, not after you're already frustrated with a price increase, but as a standing annual habit. The same way you might get an annual physical regardless of whether anything feels wrong. This single habit alone removes you from the price inelastic classification within the pricing model's own data. Because a documented pattern of shopping behavior is precisely the variable the model is tracking. Second, if your renewal price rises and a comparison quote comes back lower, call your current insurer and speak specifically to retention, not general customer service. And state plainly that you've received a lower quote elsewhere and are considering switching. You don't need to be confrontational, and you don't need to exaggerate. The retention department's entire function is to have pricing flexibility that general renewal processing doesn't have access to, and in case after case documented across consumer complaint databases. That flexibility produces a meaningfully lower number within minutes, precisely because the department exists to prevent the one behavior the pricing model fears most, an actual departure. Third, and this is the part almost nobody does, ask directly whether the price you're being offered reflects any factors beyond your risk profile, including historical renewal behavior or predicted price sensitivity. In states where price optimization based on non-risk factors has been restricted or requires disclosure, insurers are required to answer this question accurately if asked directly. Most customers never ask, which means most customers never find out, which is precisely how the system continues functioning exactly as designed. Here's the broader pattern worth naming before we close, because it extends well past insurance. Any company that profits more from your inertia than from your satisfaction has a structural incentive to make comparison difficult, whether that's through complexity, infrequency, or simple obscurity, and to price differently for customers who have demonstrated they won't check. Insurance is simply one of the clearest documented cases, because regulators have actually investigated it and produced a public record confirming the mechanism exists. Your bank, your phone carrier, your streaming bundle likely all run some version of the same logic, just with less regulatory scrutiny and less clear terminology attached to it. Alina's story ends simply, and that simplicity is the point. She didn't need a financial advisor. She didn't need to become an expert in actuarial pricing models. She needed one outside quote, obtained almost by accident, and a 4-minute phone call to a retention department that had a better price sitting there the entire time, waiting for someone to ask for it. The base isn't a permanent identity. It's a behavior, and behaviors are the one part of this entire mechanism that's actually within your control, even when the pricing model behind it isn't. So before your next renewal notice arrives, and it will arrive quietly exactly on schedule, the same way it always does, take the 20 minutes to get one outside quote. Not because your current company is necessarily cheating you. Simply because the only way to know whether you're paying a risk-based price or a behavior-based price is to generate the one data point. The entire system is quietly betting you'll never bother to collect.